is the DeFi Decoded podcast by 9 Point Partners in cooperation with Prophecy DeFi. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Hello and welcome back to another episode of DeFi Decoded. I'm Alex Tapscott here with Andrew Young. We've got a great episode for you. A little bit later, we're going to be sitting down with Scott Melker, aka the Wolf of All Streets, a popular podcaster, trader, jack of all trades, a great guest and a former guest of DeFi Decoded and a fan favorite. So we're really looking forward to that chat. But first, Andrew, a bunch of stuff in the news. I really want to get your opinion on it. One of the things that's making the rounds on crypto Twitter is this op-ed from Arthur Hayes talking about his investment thesis for Ethereum. And he's saying that he's got a target of $10,000 by the year end. Now, high and sometimes outlandish targets are common in crypto. A lot of people will throw a number out there and never really be held to account whether it hits the target or not. But this is a very different approach because it's actually based on real analysis here. And basically what Hayes is saying is that Ethereum post the merge is going to look a lot like a bond. And for those who may recall our conversation with Charlie Morris a few weeks ago, he was talking about his thesis for crypto overall and how the migration of Ethereum's network from proof of work to proof of stake mining, combined with the recent upgrade to the network that basically burns a certain amount of ether, is going to make Ethereum a much more scarce asset with a lot less available supply. And all things being equal, that should push up the price. So we've seen a little bit of this thesis from Charlie. But Arthur, I think, takes it one step, well, maybe not one step, but a couple steps further and really provides some insights. So let's talk about that. What did you make of the analysis? And do you agree?
Yeah, I mean, I'm obviously a huge Ethereum bull, as I believe you are as well. It's a very good article for anyone to go check out. Like I definitely, it's quite detailed, so I definitely think you're not going to be able to get the full gist from just us, but essentially what he's doing is he put together a scenario analysis looking at sort of the amount of essentially just projecting out the staking APR, so the rate that you can earn from staking ETH, and then essentially just compares that to traditional bonds, and essentially from there says, okay, to get to sort of the same yields of these different bonds, the price of ETH will have to go up X amount. And he has sort of a optimistic best guess and then conservative. And essentially what he's predicting is his sort of best guess is around 9.6% staking APR, based on, I believe it's 40 million ETH are going to be staked, which is also really good for the price of ETH because that means about a third of the total supply of ETH is now going to be just taken out of circulating supply and locked up in ETH. And then from there, he just looks at transaction fees and then also takes into account the yearly burn. So what's interesting about this too is with the merge, Ethereum is actually going to become a net deflationary asset. And the amount of fees that are actually going to be burned is he's projecting about 3 million ETH, which is currently about 2.5%. So you can think of it as kind of like a 2.5% yield or buyback yield. And then when you factor in the staking APR, you get a very, very attractive sort of overall yield. And then essentially from there, he says, he kind of just says, he comes out to this final number, which is sort of net yearly staking APR, which comes out to about 5.4%. And then from there, he just says, okay, like, I mean, it's very detailed, so I don't want to go too much into it, but essentially he just looks at treasury yields and sort of back calculates what the yield of ETH should be.
Yeah.
And it comes out to 10. And by the way, this is $10,000 by the end of this year.
Yeah. So $10,000 by the end of this year would translates to about $1.5 trillion market capitalization. So that would put Ethereum in the league of some of the biggest sort of FANG stocks in terms of market cap. Not as big as Apple or Microsoft, but as big as an Amazon, for example. And what's interesting to me is that saying something is bond-like in this environment seems like more of a liability than an asset, because we're in this period of rising interest rates. And even if you don't know anything about how fixed income works, when rates go up, bond prices go down, because new issues of the bond need to adjust the price to reflect that new yield. And in other words, so in other words, from Ethereum's perspective, that doesn't sound like a good thing. But Ethereum, the underlying asset, is not a bond. Ethereum, the underlying asset and the underlying ecosystem, is a lot more like a FANG stock in the sense that it's an application ecosystem, and the more applications that are in the ecosystem, the more useful the whole ecosystem becomes, and the more users, then the more adoption. So in many respects, it's almost like owning a FANG stock that has super high yield income, essentially, in a deflationary environment, which it sounds like an asset that's too good to be true almost, right? We're in this rising rate environment, so you don't want to own bonds, but you want yield. This thing's got a yield that's 500-600 basis points above prime if it's 6% or whatever it is. And it's a growth stock in the sense that it's got a growthy kind of ecosystem around it, right? So obviously we're bullish on Ethereum. The counterpoint to all of this would be, well, if Ethereum becomes deflationary and the asset becomes really expensive and they don't solve for gas fees or any of these other issues, then it doesn't matter how deflationary it is, people might migrate to other chains. And so actually that could become almost a headwind, not a tailwind. I'm wondering if you've thought about that at all. And what kind of things Ethereum has that could potentially overcome that.
Yeah, so just real quick before I get to your question, I think that is exactly how I describe ETH to sort of traditional investors. It's post-merge, ETH is essentially a incredibly high growth, think of it as an incredibly high growth tech stock with very, in my opinion, very high defensibility. It literally is a network. It is a net. When people sort of talk about network effects, which are kind of the main sort of moat for tech companies. And it's got thousands of developers, thousands of applications. Its sort of currency is unlike a stock. Its currency is actually the Ethereum ETH is actually used as a currency within its ecosystem as well, and sort of traded 24/7 like a commodity. So I do think it's far more defensible relative to a traditional tech stock, yet trades at much lower multiples. And I think part of that is due to the fact that a lot of traditional sort of institutions aren't able to play in the space yet. So that's kind of like this artificial barrier. And then second is everyone kind of thinks of crypto assets as non-yielding, non-income producing assets. Yeah. And the post-merge, this is totally different. Ether is essentially a incredibly fast-growing tech stock with arguably higher moats than traditional tech stocks, with a net 3% burn, which is essentially a buyback yield. Yeah. And then on top of that, another sort of, call it 4 to 6% staking yield, which is, you can think of it as almost like a dividend yield. So to me, you could argue it's one of the most undervalued assets, both in the crypto sphere, but then also just overall within traditional financial markets. And
I'll add that Ethereum in the past 7 days, there's been a bit of a bump here in the market, and it's up 6.5%, whereas Bitcoin's basically flat over the same period. So maybe people are positioning themselves ahead of the merge. But what's sort of challenges that thesis is that in the same time frame, Solana and Terra, the two of the larger sort of other ecosystem layer ones, whatever, are up about 20% each. And Avalanche is up about the same as Ethereum is, so kind of keeping pace. What do you make of that? Like, why are the other layer ones participating more in this rally, I guess, than Ethereum is at this point? And maybe that's, I know that's a big question, but I just want to hear your quick thoughts.
Yeah, no, I think, here's the thing with a lot of these alternative layer ones, they're typically sort of higher beta, you know what I mean? So if the crypto market's moving, they're going to outperform. Where Ethereum's outperformance typically comes from is during the downturns. It just doesn't really get hit as hard as smaller crypto assets. And I would say the same for L1s. And I mean, a lot of it too, more of Ethereum's value comes from actual fundamental value versus alternative layer ones. More of it's from speculative value. Arthur actually has this great chart in the article where he compares, he creates this like almost like a P multiple, but it's price per developer. And he had, so for example, Solana and Terra, Solana had a price per developer of $150 million per, $150 million of market cap per developer.
Yeah.
I'm not totally sure where he's getting the developer metric from. It doesn't seem right, but I think he's just looking at like GitHub commits and different, using sort of a basic metric. And Terra is at over $200 million per developer. And then ETH is below 100 million. Interestingly enough, actually, Polkadot has the smallest price per developer. So if you're looking for an alternative layer one that is relatively undervalued, at least according to this metric.
Yeah, on that metric, yeah.
Polkadot is actually the cheapest, which makes sense because Polkadot hasn't really fully launched yet, but has tons of developers. But anyways, yeah. So I think just to answer your question, though, I think it's partly just kind of a short-term sort of beta. I don't know. I'm kind of curious. What do you think it is?
Yeah, I'm not sure that the two are related. Like, I think that there's some other things happening in, for example, the Terra ecosystem that is drawing a lot of interest. You know, with Do Kwon, the founder, we talked about him like the last time, is you know, in the market as the biggest whale buyer of Bitcoin, and I think that's drawing some eyeballs to that project. And I think you're right in general. You know, the rising tide lifts most boats. We are seeing some bifurcation where, you know, projects that don't have fundamentals aren't participating, but the best sort of leading and most popular and most well-known large blockchain projects definitely, you know, participate when Ethereum goes up. Andrew, there's a lot that we have to talk about, and fortunately, we're joined by the Wolf of all streets, Scott Melker. Welcome to the show.
What's up, guys? How are you? Thanks for having me back again. Yeah,
our pleasure. Thanks for agreeing to join us on such short notice. You know,
anytime.
I was talking to Andrew, and you know, we were saying, God, there's a lot going on in the world right now. You know, not just the war in Ukraine, but you know, this rate environment, inflation. We're seeing bonds getting slaughtered, especially long duration bonds, with this worry about, you know, inflation and rates, and crypto has sort of held in there and maybe even done better than I think a lot of people might have expected. You know, if you look at the different metrics, like Bitcoin's flat on the year right now versus the NASDAQ still down about 5%, and actually the 30-year US bond is down. So we're seeing this kind of weird, if you thought it was risk off, well, maybe, but it's a bit more complicated than that, right? Because we've got assets like crypto assets that are actually performing somewhat okay, and in some cases actually doing really well. So, you know, I don't know where the question is here, but if you could just sort of summarize your view on the state of the macro situation today, what would it be?
State of the macro situation in my mind is that it's a big conversation when prices are going down and completely forgotten seemingly when prices are going up, which I find to be very entertaining and interesting in the crypto community. People panic over literally everything on the way down. And now that prices bounce from, you know, 33 up to the mid 40s, seemingly people are bullish again and the macro environment is in the rear view, although nothing literally has changed except for the price and the chart. Right. So that's just a little take on sort of the human emotion of this community and the way that we love to panic when things are going down, but it's really because of the price and not because of the macro. In my opinion, and I think it's supported by math, Bitcoin is a beautifully uncorrelated asset, right? And correlation should be determined and viewed over a long time frame and never over a week or a month, right? And so I think people get caught up in the correlation of these risk-off environments and thinking that Bitcoin and crypto are traveling with the stock market or others, which is a very, very temporary thing. And when you zoom out, you know, we have a 0.16 historical correlation between stocks and Bitcoin, basically not correlated at all. Sure. So I think that it's fun to talk about the narratives and how they will affect Bitcoin. But if you really zoom out, largely Bitcoin is its own free market and sort of traveling separately, right? Of course, Bitcoin has performed relatively well if you think about it over the year. As you said, yes, we are flat. NASDAQ's down 5%. I mean, to me, that's not a massive gap that gives us much information. But I think that right now we're just waiting for another major catalyst. You know, maybe it's the Miami Bitcoin convention, and it's true that Jack Mallers is going to announce that Apple will be taking payments. Maybe it's another country, a Mexico or a Honduras, adopting Bitcoin, something like that. But it's very impressive to see how well Bitcoin is doing, even if that just means flat in this environment.
Yeah, well, you mentioned the correlations. You know, I think you and I have actually talked about this before on your show. You know, Bitcoin for most of its history has been uncorrelated, and the same is even true over the last, you know, year and a half period. So you might have thought as it's getting bigger, maybe it's turning into more of like a generic asset. And so far that hasn't been true. And I wonder what things look like in the future. Like 0.16 suggests that it has a low to no correlation, but I wonder if at some point it actually goes to a negative correlation, or it actually becomes something that moves opposite other major asset classes for whatever reason. Maybe, you know, it's the store of value thesis for Bitcoin, or what Andrew and I, you know, were talking about earlier. You know, Ethereum, let's not forget, is almost 65% the size of Bitcoin, and it's about to have its own evolution that is going to change its math so that it becomes, you know, more like a store of value asset as well. So I'm just wondering, like, what that's where we are today, but where do you see this kind of going in the future?
I mean, if we want to talk about correlations and inverse correlations, the strongest case you're going to have is that Bitcoin maybe has a slight inverse correlation to the dollar, like many assets, right? So it's less about the correlation between Bitcoin and other assets and how much they are inversely correlated to dollar strength, right? And of course, for people who don't understand the DXY, it's not dollar strength in a vacuum. It's dollar strength versus a basket of other currencies. So when people talk about dollar strength, often your average person gets confused. They're printing so much money. How can the dollar be strong? Well, it just has to be the prettiest pig in the pen, right? You have to be better than a bunch of other garbage, right? The least smelly garbage, if you want to put it that way. So I think that there is an argument to be made at times, although really I have not run the math in quite a while on that inverse correlation. But as to where we are, I do think that there will be a time that each of these narratives plays out. But I don't expect at this point, having been here for 6 years, that Bitcoin will like solidify one narrative as we've sort of expected it to through time, right? Peer-to-peer cash, store of value, digital gold. Now it's the best asset we have for charitable donations to countries that are in a war, right? Yeah. And that's not a use case that we saw being meaningful probably a few months ago, right? Yeah. Canada, my gosh, right? For seeing what's happening with the truckers in Canada, seeing the Canadian government of all places stepping in and freezing people's accounts and blocking transactions. So I think that we are very early in the Bitcoin story. And so it's almost hard at this point. And I look back at old interviews and my thought processes, and not that we're necessarily being proven wrong. It just evolves way beyond what we even imagined at that time, right? Yeah. It's just these endless rolling positive narratives about how these assets are improving people's lives on a day-to-day basis. And that's so much more important than the price of the asset at any given moment.
Well, it's interesting you say that about the truckers and about Ukraine. And, you know, you might think, what do a bunch of disgruntled truckers have to do with, you know, people in Ukraine who are fighting this invasion? Well, I guess the common bond is the idea of censorship resistant money, right? That you can direct money towards whatever cause you want, whether it's one that's not shared by everybody, like in the truckers, or whether it's difficult to, you know, use traditional means because you're in a war zone. And that's always been this part of crypto that's, I think, been not theoretical, because we've seen tons of examples of this, whether it's, you know, the Belarus or Hong Kong or Myanmar, like these examples of crypto being used to fund dissidents and so forth, but never quite on this scale where it's, you know, okay, we're talking about tens, if not hundreds of millions of dollars, making a real difference. And, you know, it's almost like this is the biggest data point that we've had to validate this thesis that we've had for so long about crypto.
I agree.
And it almost seems now like, you know, there was a time, and I was listening to another podcast, which, you know, if for those who are listening, Uncommon Core, they do an episode once in a while. And Su Zhu, who's the chief investment officer of Three Arrows Capital, basically said, you know, for most of crypto's history, you could make the case, like people who are dismissive of it made the case that it was either A, frivolous, speculative, or B, that it was dangerous and subversive. And now basically that first argument is kind of moot because it's obviously not frivolous. We've seen $25 billion of VC investment go into it. User growth is exploding. According to Chainalysis, I think it was 800% last year. We're seeing crypto being used to direct huge amounts of money towards war effort in Ukraine. So it's anything but frivolous. If anything, it's sort of essential technology, right? And foundational to this new era. But now we're seeing more people in government make the case that it's definitely dangerous or subversive, and it needs to be controlled. And it seems like there's a growing chorus. It's not universal, but from certain lawmakers and people in power about that. What do you make of the general like regulatory ebb and flow and a perspective on the space right now?
First, I would say that it's a few people with very large bullhorns, right? And I don't think that it's actually consensus. I just think it's the way that the messaging is being delivered to us through the media and the people who are getting through basically the fog to get their message out, aka Elizabeth Warren, right? We can just go ahead and say it because we know exactly who we're talking about. Perhaps Gary Gensler and others, although he's been largely quiet. First, to your point, I just want to say about it being for criminals and illicit activity. Mark Yusko years ago told me something I loved. And he said that in his investing career, he was always criticized for being on the side of the criminals and making these crazy investments because he invested in the internet early and he invested in Bitcoin early, right? The internet was for pornographers and criminals, and Bitcoin was for drug addicts and selling weapons, which was not the case. But, these were obviously the narratives. When you're early in something that's nascent, those are the people that generally try it first, right? And so it just is a part of the maturing process, I would say. As for the regulatory environment that we're seeing now, I'm actually, in the United States, at least, we'll start there. I'm encouraged. 9, 10, 12 months ago, when they would have congressional hearings and we would see CEOs of crypto exchanges on the floor, it would basically just be a bunch of boomers screaming in their face about how it was for criminals and illicit activity. Well, that's changed, right? The last time when SBF was on the floor, famously with his poorly tied shoes, and all of the other executives, it really seemed like there had been a change in tone, largely since the infrastructure bill, to be quite honest, but a change in tone to where they were asking legitimate questions and seemed actually interested. Now, do I believe that's because they're supporters of crypto or they love Bitcoin? Absolutely not. I believe it's because they see a tidal shift in their constituency and they want to keep their jobs, right? And politicians do one thing very well. Speak to their constituents, say what they think their constituents want to hear, and raise money to deliver that message, right? Maybe that's more than one thing, but it's all bundled together. So I think that now we have, roughly approximately maybe 60 million people in the United States who are exposed to this asset class, hold some kind of crypto. And that's enough that now voters care and politicians have to have an opinion. So the infrastructure bill last year was the greatest accidental advertisement and PR campaign for crypto ever, right? They tried to slide in one little line basically to raise a bit of extra taxes. And the entire community came up in arms and froze the infrastructure bill, which was the largest piece of legislation for the Biden administration ever, for 5 days. That obviously gets every congressperson, regulator, senators, and everyone in the White House's attention. So that's what I think happened here. They have to pay attention because they're afraid that the voters will care and they have to have an opinion. And to be quite frank, we have this strange sort of bipolarity that people are viewing that's not the case. They think that the far right is very Bitcoin, are supporting Bitcoin, that the far left is against it. But I would venture to say that 90% of the politicians are somewhere in the middle and they're formulating their opinion. And largely, it's not a bipartisan issue at all. There's plenty of Democrats I've spoken to, Ro Khanna, guys like that, who are very supportive of Bitcoin and tech and believe in privacy. And there's plenty of people on the right who think that it's only for criminals, right? So I think that I think that the infrastructure bill was a bit of an abortion, frankly, but will probably be fixed, right? I think that they'll go back and write that. I think that Senators Lummis and others, Toomey, are making real strides to give very reasonable regulation on stablecoins. Yes, they should be backed. I don't think that's so controversial, right? Prove that your stablecoins are backed and that a bank run won't crash the system. Okay, I think we can live with that. right? And so I think now the attention is sort of turning to the EU, where it seems like they're less reasonable. And because it's not country by country, and I think those are not the same kind of elected officials, that they have less pressure from a constituency to make good decisions. And that's where we're seeing these nonsense KYC, $1,000 transaction. You have to gather the information of the person you're sending to. That's so atrociously, offensively stupid that it's almost hard to put into words. Yeah. Imagine that the three of us go to dinner and we get Super Bowl tickets, right? And I front the bill. And so it's like 10 grand and you guys each owe me $3,333.33 with a little line on top of it to split, right? And you want to Venmo me that cash. Can you imagine if I had to ask you for your ID, collect all of your information, then send that to the appropriate authorities before I could accept you paying me back for our Super Bowl tickets? Because that's what's happening here, singled out only to one asset class, which is just money like any other. It's absurd, and frankly, it passed with way less fanfare than the criticism we saw of the infrastructure bill because of the structure of government over there. So I think that that's problematic, but yet again, I think all of these things are so irrational that they will be fixed. Maybe I'm a glass half full guy, but I think we now have a starting point and we have outrage, and that will get it likely corrected.
Yeah. Well, it sounds like that would be so difficult in relation to those Super Bowl tickets that you just have to buy them for us. We wouldn't pay you back. I mean, I guess that's just the way it goes.
Free tickets on me. Let's go.
So I'm not necessarily against that. No, but in all seriousness, I mean, you glass half full, glass half empty. It's all about perspective on the whole criminal thing. I mean, this is such a overly, analyzed subject, but Chainalysis did the analysis, and it depends. Two things can be true, right? Bitcoin was used for $12 billion of criminal activity last year, the most ever. At the same time, the share of Bitcoin transactions used for illicit activity dropped to 15 basis points, the lowest ever, and a tenth as much as cash, right? Those are actually from the same paragraph in the same report. So depending on, as a journalist or whomever, a commenter or politician, whatever your objective is, whatever your narrative, you can fit the data, right? They say there's lies, damn lies, and then there's statistics. And sometimes data can be extremely misleading. So I just wanted to make that point.
I 100% agree, obviously.
Yeah, Scott, also before you came on, we were talking about the Arthur Hayes article on Ether going to 10K. I'm not sure if you saw it, but it's a great article. Essentially, he compares Ether post-merge to a commodity-linked bond, given the sort of staking yield and also the sort of burning of ETH from transaction fees. And one thing I'm really interested on your opinion, because I'm not as sort of into the Bitcoin world, I guess, is what do you think about this sort of bifurcation that's going to be happening now between sort of income-producing crypto assets like ETH and things like Bitcoin, which obviously don't have a sort of an income tied to it, at least directly?
There was I reference this often, but there was a great Fidelity report a few weeks back that was, I think it was called Bitcoin First. And it sort of approached that bifurcation saying there's Bitcoin, and then there's an entirely other asset class of these digital assets, crypto assets, whatever you want to call them, led by Ethereum, of course, that behave like technology or venture capital investments. I believe they actually said venture capital investments in technology. I think that also is too much of a constrictive basket to put all of them together. But I do like the fact that they just basically put up this massive wall between it, right? Bitcoin is what it is. We all love it. It continues to evolve. Now let's look at everything else, right? So I think that is the proper approach for it. I loved Arthur's article. It makes so much sense. And it's amazing that somebody wrote it, because now it was funny, sort of the tone he used, right? I think he called like institutional clowns or something like that when referencing all the people that would likely come in. But there's a endless hunt for yield right now. Individuals, institutions across the board, right? And I think we all know that DeFi is the place to get it, but I don't think your average institution right now is ready to park their assets on a CeFi platform, frankly. I don't think they're really ready even to be LPs or to really touch DeFi, but they get commodity linked bond, they get that sort of corollary, right? And so if you can borrow cash for a couple percent and do the carry trade, right? Take a low interest loan on your cash, go buy 32 ETH, park it into the smart contract, make 10 to 15% yield, and then eventually sell and pay back your loan. You're making, I don't know, free money, right? And free money is really attractive to institutions last time I checked, and sort of safe and guaranteed yield. Of course, if Ethereum goes to zero, that would be problematic, right? But assuming that you have any belief in it, I don't think that's going to happen. So I think that, first of all, I'm quite sure that we're going to see many innovative products searching for yield on Bitcoin. Right. So I don't think that obviously we have products like Stacks and Sovereign and all these people sort of doing smart contract type things and DeFi around Bitcoin. So that will exist. But I think that all eyes are going to be on ETH, assuming, which I do, that the merge will be successful. There'll be no major bugs or crashes or forks or any of the other sort of narratives that we've heard. And listen, anything's possible. I'm not a developer, so I don't know. But assuming that this all goes well, I mean, ETH is positioned to just absolutely go bananas. I think 10,000 is a conservative, if not low, estimate.
Yeah, I totally.
Andrew, before you go, I just, Scott, you were talking, I just realized, Ethereum and Bitcoin are the only two crypto assets that have a regulated futures market. And the Ethereum futures market on CME it's decent, but it's not super deep. But like the trade you just described is like, you can get to a loan from your prime broker at 2%, buy ETH. And, Andrew and I were talking about what the math looks like. Well, like, it's, even if it's 6 or 7%, you can actually offset the price risk by shorting the futures. And, any trader could do that with perps or whatever, but I'm talking about like the institutional trade, like who are these institutional buyers? Why not arbitrage the yield by using the regulated futures market? And that's something that, Bitcoin doesn't have a yield, Ethereum does have a yield. That's something you could do relatively easily, because the yield, whatever it is, AY, is going to be way greater than your cost of capital in this situation. And if you
the cash and carry trade, the cash and carry trade on Bitcoin was how most of the CeFi platforms were offering yield, or obviously trading the GBTC premium, which ceased to exist. But I mean, buying spot, shorting future, and capturing the spread in between. And now, as you said, you add into that the fact that you can actually get that ETH on a low interest loan and earn the actual interest in between. This is going to be a trade that's going to attract a hell of a lot of attention from institutional guys who get this.
Yeah, and one huge potential catalyst I do see for Bitcoin, and it's kind of interesting because it's coming from an alternative layer one, which a lot of sort of goes against what a lot of sort of Bitcoin maximalists would agree with, is Terra and UST. And so to me, what's really interesting is Bitcoin. So UST is a stable coin, pegged 1-to-1. And what is backing UST increasingly is actually Bitcoin. So Terra has announced that they're going to make 40% of their reserve Bitcoin. I believe it's $3 billion at the moment of BTC, and there's a huge catalyst.
Yeah.
I'm kind of curious, I guess, what do you think about the sustainability of UST? We've sort of talked a little bit about it, about sort of the flywheel effects, which work really well on the upside, can work really poorly on the downside. But then also just kind of the potential for UST to become the dominant stablecoin, which in a way makes all of DeFi backed by Bitcoin in the end, which is kind of a funny turnaround.
I love the narrative. Yet again, not a developer, so I haven't been far enough down the algorithmic stablecoin hole to really, I think, be able to comprehend the risk on my own, right? I mean, I've read obviously superficially about it. I think it's incredible. But more importantly, I think this is not a narrative about Luna as much as it is about, Do Kwon saying, I want to be backed by the hardest asset that exists. And it's sort of an endorsement of Bitcoin, of course. And then, of course, when you have someone that's buying 100 million plus Bitcoin a day effectively for a few weeks, price is going to go up. And he's saying that he's going to have 10 billion and be the second largest wallet after Satoshi's sort of lost or locked coins, right? I think that's a narrative we can all love. And when it comes to the Bitcoin maximalism side, well, Bitcoin maxis, anyone who buys Bitcoin becomes a friend of the Bitcoin maximalists, right? I mean, even the politicians you hate, the countries you hate, the governments you hate, whatever, start buying Bitcoin. We love it, right? All of a sudden, And so I'm not surprised that they're sort of separating the excitement about the narrative of Bitcoin being worthy of backing the reserve and what it's actually backing the reserve for, which is probably anti sort of the Bitcoin maximalist ethos. But I think that if they're really going to buy 10 billion, then that is enough in this nascent market to continue pushing price up, especially once you get the narrative and other people are buying it. As for the flywheel effect, I leave that to people who understand it a bit better, but I know there are definitely risks to algorithmic stablecoins. And so I think that's a lot of reason that regulators are talking about, obviously, just put $1 in the bank and call it a day, right? And we'll understand exactly what the risk is. It's
like that Curb Your Enthusiasm episode, where Larry is dating the Palestinian woman and loves the restaurant where she works at. But then, everyone's saying, oh, you can't support him. And it's like, if I'm a Bitcoiner, it's like, on the one hand, this guy Do Kwon is buying all this Bitcoin and that pushes the number up. But on the other hand, he's doing it because maybe Bitcoin is limited as a medium of exchange and stable coins are better. And it's actually sort of like undermining the narrative almost for, what Bitcoin's supposed to do. I don't know. It's a bit of cognitive dissonance, but I think, Scott, to your point, it's like all of a sudden, whenever someone just buys Bitcoin in general, it's like, yay, you're part of the team now.
It doesn't even have to be much. Right.
I know.
It's like you buy one Bitcoin and you're like a politician, you're like Jesus equivalent, and you're here and you're part of the community.
Yeah, the Bitcoin people are just a bit too thirsty when it comes to good news. It's like they'll take any like tiny morsel of something and turn it into like the biggest deal ever. And it's like, I'm not sure actually that's what happened. But anyway, I digress. Let Bitcoin stand on its own merits. You don't necessarily need
and
to,
I
like,
think it does.
and
I think it does
positively,
I think toxic Bitcoin maximalism is actually, yet again, I think it's more of a narrative than a reality at this point too. Like maybe a few loud voices, but I think that even some of the more hardcore Bitcoiners I've seen over time, even if it's just parking it somewhere for yield, that's something that a hardcore Bitcoiner would have never done before. Right? It was always not your keys, not your coins. You have to self-custody everything. And then you've seen huge Bitcoiners be like, well, I'm lending out 10% of my coins to earn a yield and to earn more Bitcoin. Or, like I said, from stacks. I mean, Munib, obviously the CEO and founder, he's a huge Bitcoiner, but he's the first to say, listen, like we have a narrative problem and we're letting these other communities sort of run with it. We need to step up and start to build other things to prove it. So yet again, I think it's loud voices that are sort of toxic, and those are vastly being diminished with time. I think your average Bitcoiner now is more, I should say, more secure or less insecure. You can choose which one in the competition, right? That Bitcoin's finally, we don't have the argument that Bitcoin's going to zero anymore, right? And I think that you had to defend that forever. For like 10 years, you just had to convince people that Bitcoin was even a viable asset and wasn't going to zero. Now everybody knows Bitcoin's not going to zero. It's on the ticker next to Apple and Tesla on CNBC, right? So now you don't have to defend it in the same way that you did before, and you can start to, I think, move on with your life a bit.
Well, I think that's that framing of, it's no longer frivolous. So now people who are critical of it are saying it's dangerous only, right? And that's not true either. I think generally the average Bitcoiner is probably becoming more just an average crypto enthusiast because it's going mainstream. That's what happens, The average person is just less weird and less dogmatic. And I'm not saying that as a criticism of people who are early into Bitcoin. It's just like, in order to believe in something when it's so early and so new and so unproven, as a lot of people did in the early days of Bitcoin, it takes a certain leap of faith. And now people don't need to make that leap of faith because the proof is self-evident that this is happening all around us. Scott, that was a great discussion. We appreciate having you on. AY, some great questions as well. Just a final note, sort of like thinking about how you're trading this market. I remember the last time you were buying the dip. Obviously, that's been working out really well. Bitcoin is up from that mid 30s level. What's your view on the market right now, quickly?
I mean, if we're talking technically, I think we're in a really interesting spot right now, and hopefully we'll still be there by the time people hear this. But I think, right around 45,000, 46,000, everything in there for Bitcoin is a extremely key level that we've been sort of trading under. To me, trading above that, which we broke, on the last weekly candle and then retested as support, that was sort of exiting accumulation and opening the door to much higher prices, in my opinion. Also a break of the 50 MA on the weekly, which obviously a lot of people watch and a lot of algorithms and bots are looking for. I mean, listen, you just play it level to level. If you're trading, I say above 45, 45.5, you're looking at 52, 53, which is, kind of the level that was lost last December when everyone said, oh shit, and things got ugly for the last 4 months. And anything above that, you start talking about the highs, right? The 60s. And if we start losing 45, you're talking about 42 and then back to the mid 30s. And I know that's the most obvious thing ever, right? If we lose this level, we keep going down. It's the dumbest trader talk, but it's just sort of the way that you have to view it if you're trying to manage and establish your risk. But I think we're in a bull market, and last time we talked, I was aggressive. I haven't been aggressively buying because I bought. Right. I bought all the 30s last summer, even down into the 20s. So now I'm just riding the train, and I'm more interested as a sort of swing trader, much more interested right now in altcoins.
Yeah. Well, I mean, if anybody's listening to this and wants to hear some up to the minute trading information on the technicals, on the fundamentals, you should 100% follow Scott. You should 100% listen to his podcast, The Wolf of Wall Streets. Over here, if you want to trade, that's great. We also, and I know Scott, you feel the same way, take the long view on these things. Sometimes the best decision is no decision, right? Especially if you are in a bull market, you just have to ride that wave. But it was a great discussion as always. Hope to have you back again. Thanks for joining us and sharing your insights on a complicated but exciting and uncertain time in the market. It's going to be an interesting rest of the year, that's for sure. That's it for DeFi Decoded today. Scott, thanks. Andrew, great as always. We'll see you guys next time. Take care.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.